Hello everyone, welcome to my YouTube channel. It's Abigail. Today, we're doing something different again. I've done something similar on my channel where I interviewed an expert in a particular space. But after my video that I made about regretting the property that I bought, as at now, from when I last checked, I've got about 600k views on that video. So if you haven't watched it yet, please, I'm going to link it up somewhere on this video. Just make sure you go and grab it and watch it so you can understand where this is coming from. I managed to get a mortgage and protection advisor on the channel, and I'm super excited about this conversation because we're going to talk about all the things you need to understand before you buy your first home. So without much ado, I'm just going to introduce her. So we have Jelony on the channel today. She is a mortgage and protection advisor at Meta Mortgages. Jelony has over 5 years experience helping clients achieve their property and protection goals, and she specializes in both residential and buy-to-let mortgages. She's worked with a wide range of people, from first-time buyers taking their first step onto the property ladder to investors expanding their portfolios. In this conversation, we are going to keep it practical. We'll actually cover how lenders assess individuals and their private credit situations in order to approve their mortgage applications. So we'll jump right into it. I have Jelony here introduce herself, and then we will jump into the questions and everything you need to know about mortgage advisory and how to get your first mortgage. Welcome to the channel.
Oh, thanks, Abigail, and thanks for inviting me onto your channel.
You're welcome. I'm really excited about this because I feel like from the feedback I've gotten, there's so many people who are just not aware. And the more we have these kind of conversations, we'll have people who are thinking, okay, I can be more confident to, get a mortgage or get my first home. So tell us from your point of view who you are and why you think this conversation is going to be very important for us.
All right. So I'm Jelony. I've been a mortgage and protection advisor. Well, I started off as just a mortgage advisor over 5 years ago. And then I went self-employed just over 2 years ago. So I've been doing mortgage and protection for over 2 years. So I do work with clients who are looking to purchase residential home, to buy-to-let landlords, whether you're new to the business or you have a portfolio. I work with all such clients.
Okay, so I do understand that you are a mortgage and protection advisor. So for someone who has never heard of a mortgage advisor, knows about maybe mortgage brokers, and also has never heard about mortgage and protection advisor, can you give us an explanation of what you actually do and why you are important in the first-time buyer home buying process?
Okay, so as a whole of market mortgage advisor, so if I get a client come to me, to start with, initially, I need to work out affordability for them before they go out and search for property. My job is to help them understand how much they can afford to buy based on their deposit and their income. Mm-hmm. So after I get the information that I need to work that out, I give them what's called a mortgage in principle, also known as a decision in principle or an agreement in principle. It's just 3 different ways of saying the same thing. So once they have that, estate agent particularly like that because then they know that you're a serious buyer. They can take that to go and search for the property. When they find a property, come to a mortgage advisor like me, because I'm the whole of market, I can place them with different lenders depending on their situation or their profile per se. If they happen to be one of those customers that have everything perfect, credit's perfect, income's amazing, right deposit, then they can pretty much go with any lender. So it's about getting them the best rate, but that isn't always the case for everybody. So I will have to match you with the best lender for your personal profile.
Right, okay, that makes sense. And what about the protection side?
So the protection side, we will do it along the mortgage. So essentially, lenders want to know that you're protected when you get this mortgage. Anything can happen. For example, you could fall ill after getting your mortgage and you're not able to work anymore. So something like income protection will ensure that you still have money coming in and you can continue paying your mortgage and other bills. So you wouldn't be in a situation where they would have to repossess the property, for example.
Okay.
Yeah, and there's obviously different types of protection, but again, it depends on you. If you're someone with children, for example, or a dependent that relies on you and your income, something like life insurance is very important. So
Right.
yeah, so there's different products. Once they come and speak to me, I can work with them to know which ones are best for them to proceed with.
And are some of these like insurance policies or that I assume are advisable, are they sometimes compulsory for some lenders to consider somebody to give them a mortgage?
When you make the application, you don't necessarily have to have anything in place.
Yeah.
But when you do get your mortgage offer, it is strongly advised that you get like buildings insurance, for example, and contents insurance as well. Yeah, buildings more so than contents, but contents is also helpful for you to protect your belongings.
What about the income protection and the life insurance, for instance?
It is, like I said, it's very advisable, but it's not a must. You don't have to take them, but it's in your best interest to take them because, you know, anything can happen.
Okay.
Yeah.
Okay. That's interesting. And what would you say will be the best time for somebody who is randomly considering buying their first property? Somebody who is, you know, thinking maybe I could start looking now. What would be the best time for that person to speak to someone like you? And if you can help us with like scenarios where people came to speak to you, but then they had waited too late. So for instance, they're looking to buy in the next 4 months, but they had to wait 1 year to fix their credit, for instance.
Well, I wouldn't necessarily say they have waited too late because you can still buy a property. It's just had they spoken to me or a broker beforehand, they may have realized, because I've had some people come to me for different reasons to say, oh, I didn't think I had enough deposit, or I was told by someone that my income wasn't enough.
Yeah.
Honestly, I've had cases where I'm scratching my head like, I don't understand.
Who told me that?
Yeah, I don't know. I've even had people with high incomes. I'm like, and their credit was fine. I'm like, I don't understand, you know. So they could have bought years ago, but because they didn't speak to, I don't know who they spoke to, so I don't want to speak badly of anyone, but they didn't speak to the right advisor to give them advice. They had to wait a bit longer. But even if you have bad credit, you can still get a mortgage. So that shouldn't deter anyone. It just means
That's quite hard to believe.
No, there's different lenders for different scenarios. The different lenders, they have different risk appetite.
Yeah.
So just because Santander can't work with you doesn't mean another specialist lender isn't willing to lend to you. So your interest rate, of course, may be different. But what I say is, you know, if it is your dream to get a property, you can go with a specialist lender for a few years and just improve your credit. And then when you remortgage, you may be in a better position to move to a lender who would give you a lower interest rate.
What is a specialist lender? That's my first time coming across the term.
Yeah, so specialist lenders, they tend to work with clients with properties that, like the high street lenders, for example, wouldn't touch. There's different levels to them. Again, like I said, they all have different risk appetite. So again, depending on your situation, whether it's your credit or the property is quirky, different lenders will, you know, work with you. And yeah, they're typically the specialist ones, the one where your situation is a bit different from most lenders to deal with you.
Okay, so let's bring it down. Let's put it in context. So if I just finished school, uni, I got a job. I've been working for about a year now, and obviously I have in plans that one day I'll own my own home. Would you say, when would you say will be the right time after someone has started working for a period of time to start speaking to a mortgage advisor?
Most lenders will consider you after 6 months of you having that job. Some of them you just need to pass probation.
Really?
Yeah.
Okay. It's getting interesting. Okay. That's very interesting because I don't know why, but I was of the view that you should have worked for about 2 years. But now that brings me to the next question, actually. What about immigrants? So I was an immigrant. I've stayed here long enough now, but I was of the view, or I think I was told, that you needed to have worked a longer number of years to get like a house, you know, a record of like your accommodation, and that helps your credit and all that stuff. So can you talk about immigrants and how the applications usually look like and timelines?
Okay. So, I mean, within a year of being in the country, providing you can prove that you're still going to remain in the country or you have plans of remaining in the country, a number of lenders are willing to work with you. They just they may require a bigger deposit.
Okay.
Yeah, than if you had indefinite leave, for example.
What does a bigger deposit look like?
I mean, some of them would consider 10-15% deposit. Yeah.
Okay.
Yeah.
I thought you were going to say 25.
I mean, you can get someone with 10-15, so you don't necessarily have to push yourself to the 25%. Yeah.
Okay.
But obviously, the bigger your deposit, the better for you. You get better rates as well. Yeah.
Okay. So then they would look at your visa situation and just
Yeah.
get enough information from you.
Your visa, they'll look at everything, your visa situation, the job you do, like I said, how long you're going to be in the country or your plans to remain in the country. Your credit also helps. So don't come in the country and start with bad credit. It's not, yeah.
Yeah, okay.
Yeah.
And also whether they have a family or not.
Yes, if they're both buying together, again, similar situation, they both need to have been here for a year. That definitely helps. If they have a family, they will assess all of that as well, but you should still be able to buy even if you have a family.
That's very interesting.
Yeah.
Okay. When a buyer comes to you, someone who's considering buying, can you give us a breakdown of all the rounded information you need from that person to check their credibility and how easy their process of getting a mortgage is going to be?
Okay. Me personally, I don't like the word easy, because just because somebody's profile is a bit more challenging, it doesn't mean they can't get a mortgage.
I like that.
So yes, I may have to work a bit more with you, and I might need extra additional information than someone whose case is more straightforward.
Yeah.
But yeah, I don't know if easy is the word I would like to use, because getting a mortgage is possible for all of you.
Okay.
Well,
It's good to know.
not necessarily all of you, but a good amount of you. Yeah,
Okay.
It's possible. So what I need to work out if I can make an application for that.
So what do they need to present to you? Like, before I approach you as a mortgage advisor, what do you think I need to prepare before I come over to you?
I would say have a look at your bank statements and have a look at your spending and the credit commitments that you have. There are certain things lenders don't like to see. So if you're doing those things, I would advise you work on eliminating them. Like relying on things like payday loans, gambling, for example, maybe avoid doing that. Having too much, relying too much on overdraft as well.
Okay.
Yeah, so they want to see that you're able to pay your credit on time and you're not constantly relying on credit. So when you get the mortgage, you can easily pay your mortgage without it becoming stressful for you. So I would say work on things like that. Also, get familiar with what you spend money on and try and budget in a way that you still have money left over at the end of the month, and it's not stressful, because you will struggle with a mortgage if you're not able to manage your income and expenses.
Okay.
I'll say have a look at your credit report as well, because sometimes I've made application for people and based on the information they've provided, it should have been a straightforward case, but sometimes unfortunately they fail at the agreement in principle stage because something showed up on their credit that even they weren't aware of.
Wow.
Yeah.
Okay.
So have a look at your credit report beforehand, and some of the things you can fix quite easily. Sometimes you can, if it's something that you're totally unaware of, you can even challenge it. So I'll say definitely do that. Yeah.
What about maybe pay slips?
Yes, definitely. We'll look at your pay slip if you're employed, so your latest 3 months. People do have variable incomes, and different lenders look at variable incomes differently. So we'd need to know how frequently you get the variable income and the different sorts of variable incomes that you get. So we'll need to look at that. If you're self-employed, then we're looking at your latest 2 years tax calculation and tax year overviews. There are other ways that we can look at your income if you are self-employed as well. But just have the conversation and we'll see which one works best to get you what you want to get.
So I've heard that having your name on the electoral roll is relevant. How relevant is it?
It helps your credits, more so to boost your credit score.
Oh, really?
Yeah.
I thought the lenders looked at that independently.
They look at a lot of things, yes, but it also helps your credit if you put your name on the electoral roll, yes.
The other thing I wanted to ask was about the bank statement. So when you look when I'm submitting my 3-month bank statement, first of all, I thought my mindset is the priority should be where my salary drops. And for me, I would usually have different bank accounts for different expenses. So like,
I dealt with this.
Yeah, so I usually would like shift £500 to my Revolut to pay all my bills, and then I'll shift whatever's left into my savings account or into my stocks and shares ISA. So if you take my main bank statement, all you see is zero, even though you see money coming. So with that scenario, what would be the best way to approach it if you're working towards a mortgage in future? Would you say do it all in one bank account so you can easily account for it, or?
I mean, it doesn't really matter because we'll request the additional bank statement anyway. It just means more admin for us, but we do need to see where your income's going and where your bills are being paid from and expenses. So it's not necessary that you have it all in one bank account or through one bank statement, as long as you can provide evidence and we can see what's coming in, what's going out. That's all that matters.
So I want us to talk about loan to value. I know it's a term that's thrown around a lot by, the mortgage world. How should we look at loan to value? How should we think about it in terms of it impacting how much we pay every month? And what are your thoughts about the different extreme loan to values that are available to individuals? And if somebody can afford to put a bigger deposit, what is your view about putting a bigger deposit rather than loaning more money? Just wanted to wrap our heads around the loan to value situation.
Okay. Firstly, I'm going to explain what a loan to value is. I'm going to try my best to explain it in the most simplest term that I can. All right. So if we look at loan and then value is basically the price of the property. So how much a property is worth. And then the loan is a percentage of your loan price against the value of the property. So if the property is worth 100K and you want to borrow 80,000, your loan to value is essentially 80% because the loan is 80% off the full value of the property. So that's what that is. When it comes to mortgages, lenders do offer you they do offer you better rates the lower your loan to value. So the lowest they go to anyway, 60%. So even if you are buying something that's 20%, your product range will still fall within the 60%. So if, for example, you have 5% deposit, so your loan to value is 95%, so you will get, your interest rate will be higher than someone who's able to put down a 20% deposit. So different lenders have different loan to value products. There isn't, everyone has a 95, 90, 85, 80, 75. Sometimes they may have 70% that covers anything from 70 to 80. Sometimes they may have 75. So different lenders do it slightly differently and they change it as well. So today they may not have a 75% loan to value product, but they might change it in a month, and they do. So it changes all the time. Should you put down a bigger deposit? If you can, you will get a better rate. But sometimes the difference isn't huge. It all depends on what rates are at the time that you're getting your mortgage. Someone who got, like, if we go back to when the rates were really low, someone who, 2020. Someone who got a 95% loan to value then got a better rate than someone who got 60% a few years later.
Yeah.
So it all depends on what rates are saying at the time. But of course, if you can put a bigger deposit, you will get a better rate.
Okay, so on the loan to value topic,
Mm-hmm.
are there lenders who are comfortable offering as high as 95% loan to value in our current day and age?
Mm-hmm.
And how do people navigate that?
So most lenders will actually offer you 95% loan to value these days.
Wow.
Yeah. So you just need to have 5%.
Is it more recent?
Yes, I would say in the past few years, yeah. When I started, it wasn't really available at the time.
That's what I thought.
Yeah, but these days, a lot of lenders will offer you.
Why do you think their risk appetite has increased so much?
Because the government has guaranteed them. So
Right, in what way?
So if, for example, they did take out a 95% loan to value, and then we start to see drastic falls in property prices, and someone whose property was loan to value was 95% a few years ago is now at 110. So basically your loan is more than your property is worth.
Yeah.
If instead of the bank losing the difference, if for example they have to repossess, the government has guaranteed that they will pay the difference. Yeah.
So the government is trying to help people get on the property ladder earlier.
Yeah.
But when you look at people's finances and people going in for the 95% loan to value, do you, maybe this might be a bit opinionated, but how comfortable are you advising people to go in for a product like that, given it seems the risk is quite high as well?
I would say very confident, especially as when I speak to my clients, what I need to know, like, what's your future plan? So we're not just buying today, like, what's your plan? So if it's something they're going to have for the long term, they will over time pay down the loan. And if they're in a fortunate position that, you know, the value of the property goes up as well, their loan to value will reduce over time. So I would typically advise them to get a product that will allow them enough time to build a decent amount of equity at least.
Now, what is your view on 100% loan to value mortgages?
Okay. 100%, I think for some people, the issue is...
First of all, does it exist?
Yes. So there are a few lenders that will do 100%.
They will buy the house for you. Literally.
Essentially, yes.
Wow.
Yeah. But they do it in a way, again, like I said, we're not just looking at today. They do it in a way that, you know, you can have the home for the long term, and take for example the income multiples is slightly less than if you were able to put down a deposit. So they do it so you're very comfortable. And I would advise people, if you are going to go for the 100% loan to value product, if you can, overpay, because these mortgages do have higher interest rates. So the sooner you can build equity, the sooner you can remortgage onto a lender that will give you a better rate.
Yeah.
So yeah, it's not for everyone, but I think if you're someone who's really struggling to get the deposit, and you've always paid your rent, you don't have an issue paying your rent, it's just the saving part that you're struggling with. Yeah. I think for those type of people, it's a really good option.
Okay, now about couples. How do you think couples should approach a mortgage? Should they go solo? I've heard this narrative online which says, oh, if you're a couple, it's better for you to get one mortgage for one person and then later use the other person's first time buyer rights to get another house that you can maybe use for a property portfolio or something like that. So pretty much you both have two first time buyer rights, stamp duty rights, you know, LISA rights. It's better to use it separately if you want to own later properties rather than combining it into one. Or there's the other narrative about combining it into one. It's a stronger application because there are two incomes involved, blah, blah, blah. Let me know your thoughts about.
So I'll address the stamp duty benefit first. If you're married, I don't think you both benefit from using that first time buyer stamp duty exemption twice. I'm not sure that's possible.
Okay.
But if you're not married, obviously seen a bit differently, you can do that. But the reason why people would come together to buy is because you can buy a nicer property, a bigger property, Yeah, I don't know where they live, but unless you're in a position where one person's income is enough to get the type of property you want, a lot of the time you need to pull together your incomes and even deposits if you both have. I know that for some people, the issue is, okay, what if we break up?
Yeah.
Then what happens? There is a legal document you can get to help you protect your percentage or whatever agreed percentage that you've both discussed. You can keep if you both go.
What's that document called?
Deed of trust. So it's a legal document that you can decide what happens, you know, if you both go your separate ways or one person wants to come out, and you can also decide your splits, who gets what as well. Yeah.
So is this in the scenario where a couple but that are not married come together to buy a property, or is it when they're actually married? Because that means they'll have to go through a formal divorce process, no?
I think you can do, whether you're married or not married, you can have this document.
Okay.
How it applies if you're going for a divorce settlement, I cannot speak on that.
Okay.
Yeah.
So also that also brings another question to mind, that how do you view couples that are not married officially anywhere, but say to you, we want to buy a property together? Is that how is the application viewed compared to like a married couple's application?
From the lender's point of view, it doesn't really make much of a difference.
Okay.
I think it's more with the solicitor, the legal side of things, that it will make a difference.
But it's mostly possible.
Yeah, it's fine either way, whether you're married or not married. You get a mortgage. I think a scenario where a couple might decide that no, one person should go for it rather than both is, let's say one person has really clean credit and the other doesn't, and they want to get the best rate that they can get.
Yeah.
Then yeah, you might consider going solo if that person's income is sufficient.
Yeah.
Also, sometimes one person might have a lot of debt, so the debt to income may be significantly impacted, and that might also reduce borrowing power as well.
Okay, that's interesting. Now I want us to move on to variable and fixed rates. What's the difference for our audience to understand, and when have you seen people go in for either rates, and how suitable it's been for their particular situations?
Okay. So the fixed rate is what most people generally go for, because you know what you're paying each month. It doesn't change for the period that you're fixed for. Variable rates, there are different types. We've got tracker, discount, and standard variable rates.
Okay.
The tracker tracks the Bank of England base rate. So your lender might give you a percentage above the base rate, whatever the base rate is. So if the Bank of England decide to reduce the base rate, you'll benefit from that.
Yeah.
But if they increase the base rate, your mortgage payments will go up.
Yeah.
Then we have what's called a standard variable rate. Basically, the lender will give you like a percentage off of whatever their standard variable rate is. But it's down to them when they change their standard variable rate. So you're basically at their mercy.
At their mercy, yeah.
Yeah. And then the standard variable rate is just the default that most people will fall on if they had a product and they didn't renew. It's typically the highest rate, standard variable rate. But the benefit of that rate, for example, is if your situation is changing and it's changing in the short term, but you don't want to get another product that you may have to pay fees to get or fees to exit, it's better to just stay on that standard variable rate for that short period.
So let's say if you're trying to sell.
Yeah, well, it depends. If you're trying to sell, sometimes it does take a long time to sell. So one of the other variable rates might be better. But if you know that it's like for a few months that this change, you're going to be in limbo, then it's probably better you go for the standard variable rate. But I will always say speak to your advisor to work out which one works out cheaper for you to do. And you said, aside from the standard variable rate, why would somebody else want to go for another tracker rate? So when we're in a volatile rate change environment, sometimes people prefer to go on a tracker because they don't want to lock themselves into a rate if they feel or think rates are coming down. So
That's what I did actually.
Yeah, so you stay on the tracker until you see that rates have stabilized and you're happy to fix, then you can then go and fix. I just want to say that with some of these products, there is a exit penalty, so just be careful. Even with the tracker, some of them have exit fees, some of them don't. Depends on the lender and depends on the product. So again, make sure you're communicating that your wants to your advisor so that they can pick the right one for you.
Okay.
Yeah.
Okay. Then I want us to talk about 2 year and 5 year. I believe those are the most common that I've seen.
Yeah.
What is the difference? Why will 2 year be more desirable at a point in time compared to 5 year, or the other way? What have you seen?
So people would typically pick 2 years if they have plans of changes in the near future. And when I say plans, maybe they want to move, or they think something's going to happen around that time and they don't want to lock themselves and be restricted.
Yeah.
So 2 years would be good for that. 5 years, people typically go for it if they don't see any changes. Their life financially is pretty much going to be quite similar in the foreseeable future, then they would go for that. But you can go for longer. But considering life does change, yeah. And if you're a single person and you have desires of having children or getting married, 10 years is a long time. All of that could happen in 10 years. So you don't want to lock yourself in for too long.
That makes sense. And in that regard, what differences do you see in the rates? Like at a point in time when you take a snapshot of the Bank of England rate and let's say it's 5%, how would the 2 year rates look compared to 5 year rates? Which ones will typically be higher?
It does change. It does change. There are some times where the 2 is better and there are times where 5 is better. It just depends on where lenders or the money market generally, where they think rates are going.
Yeah.
So there's never a period where I could say 2 is always the cheapest or 5 is always the cheapest. It really does change. Like when I did my I did product transfer. At the time, 5 year was cheaper, but more recently I've seen the 2 year
Being cheaper.
Yeah.
So you said something about depending on what the money market is looking like. Is there a situation where you or the first time buyer can find out what the expectations or what the money market is thinking is going to happen in the near time future?
So a lot of the time they're not going to know how to read it, but as mortgage advisor, we use something called the SONIA swap rates to see the direction, but that changes quite a lot as well. But as a regular person that isn't in the mortgage field, that's just going to be gibberish to you if you have it.
Because I'm just wondering that if the financiers or the lenders are thinking, oh, rates are going to go lower, so we're going to make 5 year more attractive so that even if, so we're going to make 5 year more attractive, then it would be great. Well, as a consumer, and also I'm quite savvy to financial markets, it would be great to know that that is where estimates are, to know whether, should I lock myself in for a 5 year or do I do a 2 year, and hopefully after the 2 years, the rates would have gone significantly lower, and then I can take advantage of another 2 year rate, if you get my point.
To be honest, the difference isn't huge a lot of the time. It's not a big difference that you're going to, save that much. And another thing to bear in mind is that with a 2 year product, depending on the size of your loan, you may have paid a product fee.
Yeah.
So if you're doing 2 years, you've already paid the fee twice compared to 5 years, you only pay it once.
That makes sense.
So there's a number of things.
All of that up, you might probably be paying way more than you're saving.
Yeah, so there's a number of factors to look at, not just if 5 years cheaper or 2 years cheaper. Depends on your personal situation as well.
The next question I have for you is about repayment mortgage and interest-only mortgage. Well, when I bought my home, it didn't even look like interest-only mortgage was available to me. I don't know why. Maybe I did not ask the question, but how does it work?
You did shared ownership, didn't you?
No, I did. No, I bought normally. I just had help to buy equity loan.
Okay.
Yeah.
So with interest only, they do require you to have a good deposit. What's the word I'm looking? equity. They require to have good equity in the property. So we're typically looking at low loan to values and high incomes as well. It's very rare that I would make an interest-only residential mortgage for a first-time buyer. Very rare. In my time of doing mortgages, without typecasting any group, it's typically older people that I've done it for.
Okay.
Yeah, not to say that younger people can't, but it's like I said, with older people, they've had time to grow equity in their property. They've had time to like build other investment, because you need to have a repayment strategy. A lot of the time for, again, the older people, they're able to downsize because they've had their children have left. So if your plan is to downsize and pay off the mortgage, they're able to do that more easily. Or if you have a big investment portfolio, so unless you're inheriting some money, or you've come from money, if you're the typical first-time buyer, you're not going to be in a position to have that kind of money.
So they wouldn't even offer you an interest only? No lender would even offer it to you?
They will if you meet the criteria, but the likelihood of meeting the criteria
is low.
As a first-time buyer is low.
Okay, that makes a lot of sense. Yeah. Okay, that makes a lot of sense, because I was just wondering why it's never offered, if that makes sense. But then I guess, but also in this situation, when people end up getting interest-only mortgages, how convincing can they be on how they'll pay off the bigger loan? Because I know you get asked that question, that what is your plan to pay off the principal if you're on interest only? So then with that, what are the most convincing ways that you can prove that you can pay off?
Most people is the sale of the property and then they downsize. That's a big one. Yeah.
That makes sense.
Yeah.
Okay, cool. Then my next question on the back of that is, if someone you're dealing with comes in and says, hey, my current rent is 1,500. When I look at all the rates you've presented, it's around 1,300 I'll be paying, but I actually want to pay about 1,001. Which options tend to be more favorable? Would it be lengthening their loan from maybe a 25 to a 35-year mortgage? Or would it be, what's the other option actually?
Bigger deposit.
Yeah, if they have a bigger deposit. So if they can get a bigger deposit, why not? But are there any other ways that we can get their monthly payments to be reduced if that is what they need at some point in time?
At some point in time. So again, it depends on the individual. If you started off with bad credit and you improve it over time, and depending on rates, when you remortgage, you can go into a high street lender. They typically have lower interest rates. So you can reduce it that way. Or you can stretch the term, or just reduce the loan to value. So
I want to ask you about how to decide about the worth of a property that you can afford.
Okay.
So depending on my salary, should I go out? Can I afford a 500K house? How do you decide how much this person can afford?
Okay. So we will look at your income, your debts, so all your credit commitment, including student loan, and we'll look at all of that, and of course look at your credit as well, and then we'll use that to determine what you can borrow. Again, depending on what type, are you a first-time buyer? Because a lot of lenders are lending more to first-time buyers than they are to just regular movers.
Yeah.
Although there are some lenders that are also lending more there, but it's very typical right now that first-time buyers are getting higher income multiples for their first home than home movers.
So when you say income multiples, how is that worked out?
So typically, income multiples would be like anywhere between 4 to 5 times your income, more so 4.5, I would say. So if you're earning, for simple maths, 50K, they would potentially lend you 250, potentially. But again, different lenders have different income multiples depending on your income. If you're a high earner, sometimes they'll lend you more. And as I said, first-time buyers, they are also lending them more as well. So the income multiple will determine, but if we have two people who earn 50K both, even if they're both first-time buyers, doesn't necessarily mean that they're both going to get the same borrowing amounts, because we have to look at their debts and their credit profile. So you may have similar profile in terms of what you make, but because of how you use credit, the borrowing amount that lenders will lend you will look different.
So on the back of that, if somebody has, let's say, a figure that the lender is willing to give them, so let's say 250,000 is what the lender is willing to loan to them. What is your view about people maxing that out? Obviously, there's a narrative online that you don't need to max that out. Like, you know, try and keep it under, because the fact that the lender says you can afford it doesn't really mean you can afford it, because, well, the economy is harder or tougher now. What do you think about it?
Yeah. So as a conservative mortgage advisor and a homeowner, I personally don't think people should max it, because things happen, and it depends. Like, let's say you have a leasehold, for example. Depending on the type of leasehold that you have, sometimes you're slapped with a significant amount that you have to pay. And if you're maxed out, that could be very stressful compared to if you take out what is comfortable for you but allows you enough to save and invest. So if you do find yourself in situations where you have to pay for repairs or pay for a significant, update to your property, you have the ability to do so because you haven't been stressed from your high mortgage payments. So my opinion is to not use the max. But I know if you work through those estate agent brokers, because the estate agents can see your max, because they work closely with those brokers, they will push you.
How do lenders view properties that need work to be done to it? So I know people like, you know, a property that's a bit old so that they can renovate it and put their own style in there. At what point is it unmortgageable? And at what point is it mortgageable so that you can get maybe a little bit more borrowing to fix it up?
Okay. There is always a lender for many situations. If it's habitable, even if it does need modernizing, more lenders would work with you.
Okay.
If it's not habitable, then you're probably looking more towards the specialist lenders. And if it's really, really bad, you might have to get like a bridging loan or cash to do it all. But most of the time you can find a lender.
So you can get a bridging loan as an individual first-time buyer?
I don't deal with bridging.
Okay.
But most of the time, the people who require that are investors. Yeah, so that's more their lane.
Okay, sorry. we'll stick to the first-time buyer lane. So a term length between 25, 30, 35 years. Tell us what your view is over there.
The longer your mortgage term, the more interest you pay over the term of the mortgage. Yes, your monthly payment will be lower if you have a long term, but you're paying a lot of interest to the bank compared to a smaller, a shorter mortgage term, but your monthly payment will be higher.
Okay.
Yeah.
Okay. So you would say if you want to pay less interest, just try and squeeze it in.
Yes, if it's affordable.
If it's affordable for you at that point in time. Okay. So tell us about shared ownership and how getting a loan for the part where the government does not own, how that works, like all the things that go into it for someone to finally say, I'm in my own space.
Okay. Well, with shared ownership, you have 3 payments that you're paying. So you're paying a mortgage, you're paying rent, and you're paying service charge. Your rent and service charge can increase annually, unlike your mortgage that you can fix for a period of time. And because it's going up annually, if you're trying to staircase to increase your percentage or...
What does staircase mean?
So staircase is basically either gradually or quickly purchasing the full percentage of the home. So you could have started from like 25%. You can gradually increase it to 100%, or you can go straight to 100% if you have the funds to allow you to do that. But every time you do staircase, there is additional solicitor fees. So the more you have to do it, the more you're paying towards solicitor fees. And I think there's slightly different stamp duty rules as well, depending on how you staircase, but speak to your solicitor about that. They can better advise on that. What do I think about shared ownership generally? Personally, this is my personal view. It doesn't mean you should follow it.
Yeah.
I think if you can avoid it, avoid it. But if it's the only way you can get on the ladder, just be smart and have a plan on how you're going to staircase 100. Because when it comes to selling, you have a smaller pool of buyers. First of all, they have to qualify in order to be able to purchase it from you. And most people want 100%. So you don't have a big pool of people coming to buy shared ownership. So so think wisely and have a plan if that is what you would like to do.
Okay. So how do you get paid?
How do I get paid?
Yes.
Yes, so
and all other mortgage advisors.
Okay, so there are two ways that we get paid. We have a broker fee, and we also get a proc fee. It's called a procuration fee from lenders as well when you complete. Because there are sometimes we do application or for one reason or another it doesn't go through, so we don't get the procuration fee. So that's why we have to charge a broker fee.
Okay. So at what point do you get paid your broker fee? And how well do I know that a mortgage broker is acting in my best interest? And it's not just trying to get me to close on a deal so they can get the fee from the bank as well.
Okay. So different brokerage do it differently. I'll be honest with you, I'm a broker that charges a fee, but there are some that don't charge a fee. Yeah, so typically with the ones that don't charge a fee, they do have to process higher volumes of mortgages. Whereas the ones that charge a fee, they're working with less clients monthly. So they're able to give that extra care and time that someone who needs to hit high target isn't able to do at all. Again, in terms of payments, different brokerage will have their different ways that they charge and when they charge.
Yes.
So there isn't a blanket way that we all charge. Yeah.
The reason why I actually agree with what you're saying, because when I bought my first home, I used a broker who didn't charge anything. And he told me that it's the bank that I loaned from that paid him. But I felt like I wasn't taken care of. And not during the process. It was after the process that I was like, I didn't know all the options. I didn't see like the person working for my situation. It just looks like these are the rates available to you. Choose one, let's go. So I kind of like understand what you mean there. The last thing that I want us to talk about, which is also around money, is what are the costs that come up along the line, and especially the ones that people are not expecting because they are first-time buyers.
Okay. So there are many fees depending on your situation, I would say. If you go with high street lender, theirs is more straightforward. So you just have the arrangement fee sometimes, depending on the products that you're going with. They do also have something called a backs transfer fee, but again, that's all included in the solicitor fees. That's just to transfer the funds, a very small fee. And then sometimes they will have what's called a mortgage discharge fee. So sometimes they will give you the option of paying it upfront. Unlike the arrangement fee that if you add it to the mortgage, you'll pay interest on. You don't pay interest on this if you decide you don't want to pay upfront.
Yeah.
It's when you remortgage or you pay off the mortgage that you have to, again, that one is a small fee. Varies from lender to lender. You can get £70 to a few £100 for a mortgage discharge fee.
Yeah.
But again, that's not something you have to pay initially. So you don't necessarily have to save for that fee. If we're having to go to like a specialist lender because of your credit, sometimes they do charge an additional, they'll charge for valuation. Then there's an admin fee, I think it's called, that they would also charge. So they do have a few more charges if you're going with a specialist lender. So that's the lender side. And of course, you also have the broker fee if you're going with a fee-paying broker. Then there's a solicitor fee. You're paying for their actual fee as well as the searches that they're doing. I always advise, especially if you're, or even if you are buying a new build, I was going to say if you're buying an older property, to do your own separate valuation survey of the property. There's different levels depending on the age of the property. I think it's a good idea to do that. You'll save more in the long run doing that. So there's that fee. Then you have things like moving costs. So I think it's a good idea to have a little bit for furniture as well. One thing I did when I moved, I changed the locks. So you may want to do that if it's not a new property. I'm just thinking, is there anything I've missed out?
You seem to have covered even more than I thought or expected. But you mentioned one thing, valuation. So for a first-time buyer, I'm guessing the bank will still do a valuation on the property. Let's say you've put in a price, an offer, right? And the valuation comes down lower. What happens?
Okay, so if this happens, depending on how much lower it's come back, that makes sense? Depending on how much lower it is, let's say it's a few thousands and it doesn't make a difference to your loan to value, then they will still proceed to, approve your mortgage if they were planning on doing that. But if it does impact your loan to value, what you can potentially do is if you have additional funds, you can either increase your deposit or increase your loan to value, the products that you're going for, if that is an option. Or you can go back to the estate agent, the seller, and renegotiate.
The first one. The value of the house is less than what I'm paying for, so you gotta come down. But I'm guessing when people get to a point where they've put in an offer, they're just so emotionally attached to the house. So even if the estate agent says, oh no, we can't, we've accepted the offer and stuff like that, then it's like, okay, I'll just work it out by increasing my deposits or something. But I think that's all I've got for today. If there's anything else you want to add that you feel like it's relevant to first-time buyers, we're happy to hear it.
I would say definitely go and speak to an advisor. Definitely. Like most of the time it is, the initial conversation is free. So they're not charging you. And even if you're a few years away, you can at least find out what you need to do to be in the best position when you're ready to purchase.
So this brings us to the end of our conversation today. I'm really excited. Let me know what you guys think. And if you need to ask any further questions, I'm going to put Jelony's details in the description. So you can just click on her number and everything, and you can reach out to her. If you want us to have another of this conversation, maybe for buy-to-lets, maybe for other questions that come up in the comments, we can find another opportunity to do a part 2 of this conversation, but it depends on what you guys want. So thanks for sticking with us. It's been a lovely evening, and catch you later. It's been Abigail.